I think we'll get started. So good afternoon. My name is Lisa Goldman. I am partner here at SAX, and I head the international tax team. And I have the pleasure to moderate this afternoon's program with my partner, Rich Goldstein. Before we get started, I kind of wanted to go through some disclaimers and just a few other general guidelines. Our firm provides this information on this webinar for general guidance and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. I also want to let you know that we will provide the slides at the end of the program. Unfortunately, we're not offering CPE today. And finally, if you have any questions, we welcome them. Please put them in the chat or the question button on the GoToWebinar screen. I think it's on the right-hand side of your screen. There's a little tab that you can push, and we will answer them as soon as we can. So with that, I'd like to present Richard Goldstein, who heads our state and local tax practice. Rich has over 30 years of state and local tax experience. His department consults on a broad spectrum of taxes, including income, franchise taxes, business property taxes, unclaimed property tax, personal tax, sales and use tax, and many other taxes. He's always my go-to guy for any state and local tax question. His department also represents taxpayers in state and local tax audit and tax appeals. Rich, welcome. It's good to see you today.
Thanks, Lisa. It's good to see you too. And I want to welcome everybody who's in attendance and thank you for being here today. So Lisa and everybody, what I wanted to talk about today, I selected this topic because it's going to have a really significant impact on businesses, particularly retailers and wholesalers who are primarily doing business, making sales online through the internet. There's going to be major changes on a multi-state basis across the country, and this is all recent developments that if you have one of those type of businesses, you really need to know about, so you're not caught off guard and potentially have the opportunity to do some planning. And Lisa, I think if it's okay with you, Lisa, the way I'd like to structure this is to sort of give a background on where the law was and is to start with, and then as we progress, we'll go into what the changes are. What do you think?
That sounds perfect to me. I couldn't have said it better than myself.
Okay.
So why don't we go to the beginning, right, to how this all started, right?
Sure. So, we have a screen here that says learning objectives. So what we're going to talk about today is, public law 86-272, which is a federal law enacted by Congress in 1959. And what it did was it provided protections for certain businesses conducting their operations throughout the country. In other words, interstate commerce. If we can go to the next slide, that would be great.
The next one after this. Yeah.
Oh yeah, maybe the next slide after that.
Perfect.
Okay. So let me give you a little bit about Public Law 86-272. So in 1959, businesses were basically getting to a point where, if they were selling it into many states, they suddenly had to file and pay net income taxes in many states, even though they might not even been present in those states. Maybe they only sold that, maybe they only sent a salesperson into the state, and maybe that salesperson was only engaged in just taking orders for goods. And there were a number of Supreme Court cases that came out that made it very difficult for industry to operate in that environment. So the only branch of government that has the ability to regulate interstate commerce is Congress, and they took the bull by the horns in 1959. And basically what this law says is that if a business engages in interstate commerce and they limit their activities to the solicitation of sales of tangible personal property, okay? So this is not a service, this doesn't protect service industries like the accounting industry, the law industry, the consulting, but it does protect those industries that sell and wholesale or retail sell into states where they don't have any operations other than, as I said earlier, sending a salesperson to try and drum up business. And what the law basically said was that if the salesperson merely solicits business, takes orders, and those orders cannot be approved by the salesperson, they have to be sent out of state to the home office, let's say, to be approved or rejected. And if approved, then the goods are shipped into the state from out of the state. So to give a little bit of context, let's say we had a business that was located in New York, and it has no other, its only warehouses are in New York, its only offices are in New York, and it's let's say it's a retailer, not a retailer, yeah, it could be a retailer, it could be a wholesaler, doesn't matter. And let's say that they decide to send a salesperson to Texas, or maybe Texas, or any other state, right? Let's use a different state than Texas. Texas,
a state that has an income tax, right?
Yeah. So let's say Massachusetts. So they send their salesperson to Massachusetts to go to, I don't know, maybe they're selling plumbing parts, and maybe they go into various plumbing stores there and contractors that are located there, saying buy this, please. And prior to this law, that company would have to file and pay net income taxes in Massachusetts, even though it really had very limited activity there. So, as long as under this law, as long as the company in New York merely sells the property through salespeople in Massachusetts, and those orders are, as I said earlier, approved or rejected back in New York, and if approved, the shipment of the product comes from New York into Massachusetts or any place other than Massachusetts, then the business is protected from paying net income taxes. And since 1959, businesses have been relying on that and doing tax planning and structuring and deciding how to operate their businesses to minimize the amount of tax compliance that they've had to do. So it's been long-standing.
Yeah, but there's had been some court cases that redefine some of the definitions in this law.
Yeah, that's good point, Lisa. As you can see, this is a very very small law. It doesn't say a lot. And one of the big issues that people were dealing with is, you're allowed to solicit sales, but what is solicitation? And is there, what can you do that doesn't go beyond solicitation? Because if it's more than solicitation, if the activity is in the state, then you don't get the protection. It's just, it just evaporates. So to your point,
there must have been one defining court case, right?
Yes, and that was
foreshadow.
Yeah, that was Wrigley's. That was the Wrigley's chewing gum company. If we go to the Wrigley's chewing gum, basically the importance of the case, and I'll go through the case quickly. It was basically what it did was it put some guardrails. The Supreme Court basically explained what Public Law 86-272 is more clearly. They created it, basically said what solicitation is. And again, remember, all you can do is solicit orders for sale. If you do more than that, if your behavior amounts to more than that, you're not protected. So in the Wrigley's case, the Supreme Court held that that Wrigley's through its sales force, that their activities went beyond soliciting sales. And what were those activities that they engaged in were, it seems silly. It seems like really limited things, like they replaced stale gum and they didn't charge for it. They'd go to the local retail outfit and they would just replace it. And, they had kept, they do agency stock checks to see how much gum was there and to see how it was being displayed. And they would, keep gum on hand in the state of Wisconsin, right, at their home for these purposes. So the Supreme Court in its wisdom said, well, this isn't really the solicitation of sales. You've already sold to these people. You're replacing stale gum, which you've already sold to them. This is going beyond that. And so guess what? Wrigley's is now a taxpayer in Wisconsin for the net income tax. And let's be clear, all we're talking about today is net income tax. We're not talking about sales tax or any other, type.
So those activities seem really limiting, like to not even be able to replace the stale gum. Was there any activities that were permitted as part of this case?
Well, that's interesting. Basically, what the Supreme Court said was that basically all they said was that they didn't go into great detail on that either. But what they said was any activity that a business would engage in, regardless of whether they had their sales force do it or some other division of the corporation, is not going to be a protected activity. So for example, in this case, placing stale gum would be a quality control issue, right? So just because you give the quality control to the salespeople doesn't make it a protected activity. So that's sort of like the litmus test. And the language they use is, if it's ancillary to solicitation, you're fine. If it's not ancillary, like in this case, doing, checking to make sure the gum's still fresh, which is a quality control thing, it's not a solicitation of an order, that's not fine, even if it's the sales force that's doing it. So I think what we probably should do is talk about what happened after this case in 1992.
Well, wait, before we do that, Alex, we go to the next slide. I think there was a de minimis rule standard that was established.
Yeah. So I mean, again, the de minimis. So the Supreme Court basically said little things that you might do aren't going to, they're not going to. If you do something and you step over the line just a little bit, that's not going to invalidate it. But they didn't really give. They didn't really. How should I say? They didn't really outline exactly what that meant. And that's what we're going to talk about. What happened in the next issue, which is the Multi-State Tax Commission. I forget, Lisa, do you recall? I think that's on slide.
That was the next slide. Yeah.
Around slide 10.
We're one slide behind. There we go.
So maybe we go to slide 9. I'm sorry. Maybe we go to slide 10. All right, slide 10. I got it. All right, so now we have Public Law 86-272. We have the Supreme Court giving some additional detail as to what solicitation means, and now the Multi-State Tax Commission, and the MTC. The MTC is a organization run by state and local governments. Well, actually, state governments, not local governments. Tax departments, and they. Basically what they do, what the MTC's job is to try and find ways to harmonize the tax laws amongst all the different states. And so the member states, the full member states, pretty much decided that whatever the MTC decides in terms of how, in this case, it's Public Law 86-272, how that should be interpreted, they will follow it and they will put that in their laws. So the MTC, basically, the members themselves are the people who basically are the MTC. They decide. So what did they do here? Keep in mind what we're going to talk about in a little while, and what makes this so important is that to this point, we haven't really been talking about interstate commerce, internet-based commerce, right? We've only been talking about old school commerce, let's say, and there still is old school commerce. And so back in around 1992, a little after that, the MTC listed these rules, and they basically said, for example, that making repairs or maintenance on property after it's sold, even if it's a small kind of a thing like an adjustment, that would exceed solicitation, and you lose the company would lose its protection, and or collecting current or delinquent accounts in the state, right, would cause you to lose your protection, the business. And installation or the supervision of installation of freestanding, let's say, racks and things of that nature, after shipment or delivery of those items would violate the protection. Conducting training courses in the state for personnel other than those involved in solicitation of sales would cause you to have to pay net income taxes in that state, and providing any kind of technical assistance as well. The point being here that the and this is just a very short list. The list goes on and on and on and on. And the point here, though, is that the MTC kind of fleshed everything out. They gave some very particular details that that the Supreme Court didn't do. They're basically interpreting the Supreme Court's decision in Wrigley's, and of course Wrigley's was interpreting the public law itself. So they also, Lisa, as you may recall, the MTC also gave lists of examples that were permitted, and I believe that those are probably on the next slide.
So Rich, in terms of like the Wrigley case, this just further defined what the Supreme Court limited in the Wrigley case, like this, or did this go one step further?
It basically took the underlying principle of the Wrigley decision was that that anything that a business would normally engage in that has nothing to do with sales, even if you have your sales force engaging in those activities are not protected. So what the MTC fleshed out was examples of activities that would violate that rule, and then also activities that would not violate that rule. And so it was terribly, it was really, really practical stuff. And retailers and wholesalers that do business in multi-state for decades, their tax advisors have been advising them on how to do business to minimize their net income taxes across the country by, fitting within the rules, particularly the rules that the MTC spelled out, and that's changing now. But before we go on to that, and we'll be there shortly, here are things that the MTC spelled out that were protected. So of course, soliciting any orders for sale of tangible personal property by any type of advertising, having an in-state resident employee, a salesperson, so long as the only place of business is in their home office, right, in the state. Now the salesperson, according to the MTC, can carry samples of the promotional materials, but for display, but they can't charge for them. That's acceptable. Setting up display racks, perfectly acceptable, so long as you're not charging for it. And the salespeople passing on orders or complaints or questions to the out-of-state home office, that's acceptable as well. Those are all things that are considered ancillary to solicitation. And if you look at a lot of these things that we're talking about, like, so for example, display racks, these are things that, it's sort of, not that we don't have display racks anymore, but these were the concerns of the MTC at the time. And it's only been the last couple of years that they started studying the impact, like how does this law relate to the new way that people do business? You know,
But I think it's interesting that you can have an employee in state as long as they're sales doing only solicitation and still not have nexus in that state. Is that what number 2 is saying?
well, you know, it's interesting that you say that because, you know, and yes, and the answer is, well, you don't have nexus for, you have nexus, but you're not obligated to pay net income taxes. So you know, just for sake of, you know, clarity here, this protection doesn't apply to gross income taxes or fixed fee minimum taxes or fixed dollar minimum taxes. It only applies to net taxes measured by net income. So if you do have an employee in the state, you might not have to pay the net income tax, but having an employee does cause a filing requirement, causes nexus. But so you may have to pay an alternative tax base like a minimum tax or a gross receipts tax. But normally those alternative tax bases result in a lower tax than the net income tax would result in. That's generally the way it works. So if you can get yourself out of paying the net income tax, even if you have to pay a fixed fee tax or gross receipts type tax, you're almost always ahead of the game in it. So it's the net income taxes that generally cost the most. So, you know, to your bottom line. So did I answer your question, Lisa?
You did, you very effectively, thank you. So I think where you were going next is that a lot of those activities talk about business the way that it was used to be done, but things have changed, right? The way that people do business.
Yeah, I mean, change, you know, I mean, when did it, I know everybody, I use Amazon, of course, everybody uses those sorts of things. But in 1992, when the Supreme Court, you know, issued the Wrigley's decision, there wasn't an Amazon. You know, people didn't, that's not how people, you know, purchase stuff. You know, and all this time has gone by, and yet there's been no update to the law or the interpretation of the law. How does internet commerce relate to Public Law 86272? Because it's, you know, internet-based commerce is essentially sales. It's sales. So the MTC engaged in a lengthy study with its member states, and then in January of this year, they finalized their statement on Public Law 86272 and internet-based commerce, and they had some interesting things to say. So I think if we go to slide 12, we'll be where we want to be.
I think this is where we are.
Okay, well then we're there.
Yeah.
All right. So you know, this is going to sound familiar. What did the MTC do? They listed examples of activities conducted on the internet that qualify for protection, and then they listed activities that don't qualify for protection. By the way, the list is a lot shorter than the pre-internet list, the internet list that is. So you know how you might go to a website and you are looking, maybe you purchase something on a website and you don't quite know why it's not turning on, or you don't know how the thing works, and you can't figure it out. And a lot of internet, a lot of these websites have what is called static FAQs, static frequently asked questions. It's just a list of questions that they think a consumer might have and answers them to those questions. But it's static. It's not. There's no interaction with the company. It's just a list of questions and answers. So according to the MTC, has taken the position that having this sort of an FAQ on your website, even though the assistance is post-sale assistance, it doesn't violate, it doesn't ruin your protection under Public Law 86272. So again, it isn't actually a sales, a solicitation of sale, right? Because it's happening after the sale, and but nevertheless, it's okay. And so all the states that subscribe to the MTC are going to incorporate that provision into their law. So we know that you can continue to do if you're selling by the internet, you keep doing that, you're not going to have any problems in the states that adopt these provisions. But here's something that a lot of internet-based sites do. I've experienced it. That does ruin your protection. So you're on a website, and again, this is post-sale. This is post-sale assistance. Instead of an FAQ, there might be a little link, and it says, "Would you like to speak to? Would you like to chat with someone who can help you?" You click on the link, and a chat box opens, and you type back and forth. My question, here's my problem, and then the person on the other side says, "Let me help you," and you go back and forth. That, according to the MTC, it ruins your business's protection in the state where your customer is located, where that conversation is happening.
So you're telling me if the website just puts FAQs up, that's not, you haven't done anything more than solicitation. But if you have this chat box that you're asking a question, all of a sudden you have nexus in that state?
Well, you have nexus, right? Because let's say you have salespeople there selling your product there. But Public Law 86272 says, hey, you have nexus, but even though you have nexus, as long as you meet the PL 86272 provisions, you don't have to pay. So it's like a get out of jail free card, right? So you have nexus.
Oh, I
you
see.
don't have to pay the net income tax. But yes, I'm sorry, Lisa, go ahead.
No. So now I understand. But I guess, if you have a chat box on the internet, if you're shopping around and you want to find out if this comes in another color, and you say, does this come in green? Now 86272 is not going to protect you, I think is.
Not quite, because this example, for example, the first item and the second item, they both deal with post-sale assistance. In other words, this is, again, like you received, you ordered I don't know, some tool, right? An electronic tool, and you can't quite figure out how to turn it on, right? Doesn't seem to be turning on. So if there's an FAQ on that's static, that's okay. But if your website hosts a chat box, and that's providing assistance, that unfortunately, in any state now that subscribes to the MTC member states, and we'll go over which states are MTC member states a little later, that's a problem, and that's going to be a problem for a lot of businesses. Because I don't know about you, Lisa, but I'm constantly seeing these chat boxes come up.
Yeah.
Whether it's on, I know, like, my Verizon mobile website, Amazon has the chat boxes. They seem to be everywhere. So the reason we're having, this discussion today is because maybe this is an opportunity for, businesses in that situation to start rethinking how their website is designed so that they can minimize their exposure to net income tax in lots of states where they don't have any physical presence other than a salesperson.
And by the way, a lot of those chat boxes are bots, so you're not even talking to a real person, you're talking to the computer.
That raises an interesting question. Like, they didn't get these rules aren't so specific to say whether, well, if it's a bot, then it doesn't count.
Yeah.
So that's an interesting issue.
That's the next step.
Make a difference? I don't know. Maybe it should make a difference. Maybe.
Yeah.
So here's something else. So frequently you'll be on a website. Let's say you're on you're on Target's website, right? And maybe Target doesn't have stores in every state, right? But they do have internet sales on every state. They sell into all the states, right? So, but they want to sell you their credit card. So you're on their website and it says, would you, please consider buying our credit card. Here's all the benefits. It'll take you 2 seconds. All you have to do is answer a couple of questions and we'll let you know very quickly whether you qualify. And we see those credit card offers all over the place on retail internet sales sites. But according to MTC, if your website does offer to credit cards, that ruins the protection. And remember, your main business is selling stuff, right? It's not getting people to get your credit card. So by offering credit cards on your website, you just ruined your net income tax protection for the whole business. Most of your revenues is not coming from the credit card. It's coming from your sales of the stuff that you sell. So again, maybe another opportunity to, rethink how you're going to have your website, how you're going to have your internet operate, and maybe you don't want to offer credit cards on your website. This is certainly a reason to not do it. Of course, business reasons may, every business is going to make that decision about, well, these are the taxes I may need to pay, but here's the benefit of, getting people to use my credit cards and, make that evaluation. So there's a lot more examples, and I think they're all relevant. So we'll go over every example here, every example the MTC has put out. I think we can go to the next slide.
I think this one talks about upgrading remote fixes. Yeah.
Yeah. So, if you were to buy, let's say, some sort of an electronic gadget, where maybe these days everything is intelligent. Even refrigerators can tell you whether it's time for you to buy, whether you have whether you need to restock or whether you need to change the water filter, all that sort of stuff, right? So if the company provides a service where they can remotely fix or upgrade a product to, let's say, the next operating system, right? And they can do that electronically. Deciding to have that as a service that you offer would ruin your protection. So what does this make me think about? Right off the top of my head, I say, well, look, we need to be able to provide remote fixes. Is it practical for us not to do that? Can we really not do that as a business? How are we going to be able to sell our stuff? Well, maybe the answer, and I'm not saying this is the answer, but something that comes to my mind is, well, maybe instead of having a different division of the company that provides this service, maybe there's a different related company that provides this service. In other words, it's not the same company. So you isolate your internet sales in one legal entity and have these other types of services that will ruin the protection in another company. I'm not saying, let me be very clear, I'm not giving advice right now. I'm just saying, my wheels are spinning and these are some of the things that I'm thinking about. And remember, this is all very new. So let's see, what else? If you sell extended warranties and you offer, if a business offers to sell extended warranties on their website, that will also defeat the immunity from the net income taxes.
But carrying your thought that you just made through, then maybe the sale of the warranty plans would be in that other separate company.
Maybe, yeah. That might be the way, around this sort of thing.
Yeah.
I mean, there are other considerations as well.
Of course, but just
and, if you've got affiliates and they're combined, what does that do to the combined entities community? So, but those are all things that we need to think through, and this is cutting edge stuff. So let's see, what else do they talk about? What else did the MTC talk about? They talked about,
Marketplace facilitator. I guess that means like if you're on Amazon, selling through Amazon or?
yeah, well, Amazon is probably a classic example of a marketplace facilitator. We see this term a lot in the context of sales and use tax. But what it really is just a online marketplace that provides the opportunity for you to sell your goods. So Amazon sells some Amazon branded stuff, but they sell a lot of stuff that is from all different unrelated third parties. And so if you're selling your goods through an Amazon or something like an Amazon, this provision is important for you to take note of. That where is your inventory being stored? So Amazon, for example, has warehouses all over the country, right? So, but do you know at any given time where your goods are being stored? You might, and you might not. So the problem is that if your marketplace facilitator is storing your inventory of your product in a state where you previously were immune under Public Law 86272 from net income taxes, you are no longer immune under this rule. So maybe, again, it's spinning, this is all new stuff. Maybe there's going to be new agreements with your marketplace facilitator where you can select which warehouses you want your product stored in. Maybe, I'm not saying, but this is all new stuff and there's going to be new solutions. That might be a solution. Let's see, if we can go to like slide 14.
This is one that I know that many people stream videos or, who has cable TV anymore? Everything's through streaming services, right?
Yeah. In fact, it's interesting you say that. Like I have my cable TV. I'm old. I still have cable TV, but I have an app on my phone. So when I go somewhere else and I'm not at home and there's a TV there, I can actually stream whatever my cable service is providing. I can just stream it. I don't have to have my cable box. I just have to have my phone. For better.
So that's for the company that provided that. I don't know who it is. That didn't help with their with 86272. Right?
Yeah, right, exactly. According to this, and there's a simple reason. This actually is a pretty obvious reason, which is that remember what we said at the very beginning, that the law itself, the public law itself, only applies by its very terms to the sale of tangible property. It doesn't apply to the sale of services. And what the MTC is saying is that streaming video and streaming music is not tangible personal property. It's not the sale of tangible personal property. And that's what they've decided. But keep in mind that in some states, for sales tax purposes, some states have defined streamed video and streamed music to literally define it as this is tangible personal property. So there's going to be a divergence between how these are treated for one type of tax or another. And one tax may say it's not tangible property. Another tax may say, like sales tax only applies to tangible property. So there's going to be an inclination to try and define the tangible property to include streamed videos when you're dealing with sales tax. So anyway, so this should be obvious, right? But that when if you have a website and customers use it to search for items they might be interested in, read the product descriptions, and then select the items for purchase and choose delivery options and pay, that does not defeat 86272. So if that's all you're doing on your website and not doing anything more, you're still good. You're still good under the public law. Yeah. So now we are on slide, okay, great. So where does this land us? I've been talking about states that follow the MTC guidelines. And there's 3 categories of states. The first one are the compact members, and those members, there's 16 of them. They're on the left-hand side of the screen. They are basically the governing board. They're the ones who are fully committed, and they're the ones who are voting on how to change the interpretations of the laws. They're basically the ones that are responsible for putting out these guidelines. These states all adopt the rules. There are some exceptions that allow compact member states not to follow them precisely, but by and large, if you're looking at any of these compact member states, Alabama, Hawaii, Oregon, any one of these, you can pretty much assume that you're going to have to follow these MTC rules that we've been discussing. Then there's the sovereignty members. There's 10 of them. And these support the MTC financially. They contribute to the organization's coffers. They also sit in on meetings, and they have input, and that, as far as what their thoughts on certain issues are. But they're not obligated to. They haven't decided that they're going to take everything that the MTC says and incorporate it into their laws. And then the largest group is the associate members, which basically they don't support the group financially, but they are, they can attend conferences and stuff, and they don't. Why are we talking about this? Because, again, it's MTC, right? So these are MTC rules. So, as you're looking at your tax planning, the states on the left side of this slide are the ones where you're going to start with immediately, because those are the ones where I got to deal with these new rules. You may have to deal with these rules in some other states as well, and we'll go into New York and New Jersey as an example of that.
Yes, I see New York is just an associate member, so that must mean that they haven't fully adopted.
Well, it's interesting. New York is just an associate member, and New York has a long history of being very independent and not following what everybody else is doing. And we see that, time and time again with all the various taxes New York has. But they actually adopted most of these provisions in regulations. They adopted them in September of 2023. So basically just in September, this past September. They didn't adopt them, every one of them. They adopted almost all of them. And they, true to New York style, New York cynics, they actually put some language in there that goes beyond what the MTC did. If we can go to the next slide, I think that's the New York slide, right?
Yes.
Okay. So as I said, they generally follow MTC rules, but here's what's different about it. They have the following provision. New York has this provision that's not in the MTC. They say that solicitation activities, solicitation is good, right? If it's just solicitation, you're good under public law. But they're saying that solicitation activities do not include activities that a corporation, and quite frankly, a business, because this is not just about corporations, this is about businesses, partnerships, it doesn't matter what the format, it could be a sole proprietorship. Public law applies to everybody. But here they say corporation that would have no reason to engage in apart from the solicitation of orders, but chooses to have that function undertaken by its sales force. And I mentioned that earlier because that is something that actually is something that was discussed in the Wrigley's case. That was sort of the thinking. The MTC didn't express that directly at all in their examples. New York put it right in there to make it clear that don't think that you can just take a normal business activity and just hand that activity to the sales force, even though it's not sales. And okay, now it's good because the sales force is doing it. So that's why I said, I kind of referenced, New York being a little cynical here. They're actually thinking that, businesses might try and do that. The other thing that they said was that, solicitation activities do not, include those activities that the business would engage in normally, but they just decide to engage in it through the internet, interacting with customers. In other words, just because you're interacting with customers through the internet, that doesn't change the conclusion as to whether or not that type of interaction is solicitation, or whether it's or whether it goes beyond solicitation. And again, it's just New York being very, trying to make its point. Lisa, you still there?
I'm still here, but we lost the slides. I don't know if
Lost the
everyone
slides.
else lost them, but
Okay, well, let's not worry about that.
I think you know your stuff well enough. You don't need a slide to explain.
All right. So in New Jersey also, although New Jersey didn't, in a policy statement, New Jersey on September 5th, 2023, New Jersey said that they will generally follow the MTC guidelines. Now, New Jersey also is not a compact member state, but they're going to follow them. And in some ways, New Jersey is actually a little nicer than the MTC. They're a little more lenient. And one of the items there was with respect to something called internet cookies. And I'm not talking about cookies that you buy and eat over the internet. I'm talking about these digital cookies that retailers place on your computer when you visit their website, and they're used for various things. One of the things they're used for is to gather information about the customer who's online, so sometimes they will use it for getting, the business will want to look to see, based on all the cookies that are out there and the hits that they've gotten from potential customers, do we need to adjust our production schedule? Do we need to increase or decrease inventory? Also, the information that they get from that potentially assist them in developing new products. That's what the cookies are used for, to identify new items to offer for sale. The MTC says, well, if that's what you're using the cookies for, that's not good. You can't do that. If you do that, then you're gonna have, then you lose your protection under the public law. New Jersey is actually more lenient. New Jersey said, you can do those things. Just don't gather your market research and sell it to third parties. So if you're doing the things that the MTC says are a no-no, New Jersey's okay if you do that. You'll still have your public law protection, unless the business decides to take all the market research they've done and sell it to a third party. If that's what you're doing with the information that you gain from your cookies, then you lose your protection. New Jersey did include some stuff that the MTC did not include, particularly regarding offering or selling digital assets, specifically selling digital assets or offering digital assets like non-fungible tokens, virtual currency. Lisa, I think you probably know what non-fungible tokens are better than me, right?
Yes, they're one of a kind, yeah. But so what did New Jersey say? Like, if you have an NFT, what?
So they're saying
if you're selling an NFTs.
It's not a protected activity because it's not tangible personal property. That's their position. So remember, the public law only applies to sales of tangible personal property. And I believe non-fungible tokens are things like you can buy a virtual piece of art, right?
Yes.
That maybe doesn't exist on a piece of paper, but exists as a file, on a digital file on a computer. And you're the only one who owns it because you have the token. I don't know if you have other examples. And again, Lisa, I'm not putting you on the spot here, but for some reason I thought, I seem to recall that you were discussing NFTs at one point a couple of years ago, but maybe not.
Yeah, NFTs. Yeah, I have several clients that, traded in NFTs or own them. But they bought them often from, I have one client in particular that bought them from the artist who created the NFTs. So I guess that artist would have maybe an income tax issue if he's,
Yes, because remember, the public law does offer protection to sole proprietors. So if the artist is a sole proprietor, but he starts, but now his art is he's having non-fungible tokens sold, he's not going to be able to, or she's not going to be able to get, the artist won't be able to get protection as it relates to the sales of NFT.
And what was pointed out by the questions that we're going to get to, that sometimes NFTs are related to a real world asset. So there may be a piece of a tangible, personal property associated with that asset, but I guess it's still not protected because of the digital nature.
Right, and it's just a matter of how the state has some latitude in how they define tangible personal property. As I mentioned earlier, some states will include, sale of music, streaming music as a tangible personal property. Doesn't seem like it should be, but sometimes you'll see for sales tax that it is. It gives an extra opportunity for the state to get sales tax revenue. So that is, I think, the end of the formal.
Yeah, unfortunately we lost the slides, but I want to let everyone know that the slides will be available after the presentation. We did have a few questions, Rich, if you have a few minutes. The first question, and which is going to take you back to, I guess, the beginning, is what part of the company's income is subject to the state's income tax when they're not a resident of that state? Is it, how does that work?
Okay, so I'm going to try and keep it really concise. So in order for a state to be able to require a business to pay tax, any kind of tax, whether it's sales tax, gross receipts taxes, or income taxes, they have to have nexus with the state. That rule applies across the state. It's a constitutional issue. And normally what that means is that the business has some connection, either employees, office, inventory, some tangible connection to the state. It's predicated, it's not always predicated on a tangible connection to the state, because there are, and again, we could have a whole other session on this, there are states that have economic nexus now, meaning even if you don't actually have anybody in the state, if the amount of sales exceed a certain amount, this is pervasive in sales tax, but it's starting to happen in income tax as well. If you exceed a certain threshold of sales or dollar sales, even though you might not have physical presence there, you still can be made to file and pay taxes. Well, maybe just repeat the question one more time, because I'm not sure.
I guess I'm going to give you an example. I'm a company here in New York, and I'm, now sold something and failed one of these protections. So in Montana. So what does that mean to me? And does it mean that all my income is subject to tax in Montana?
No. Well, okay. So first, if the public law we just discussed applies, it means that you won't pay a net income tax to that state, period. You might pay other taxes to that state, and usually it's not on your entire gross receipts or your entire income, it's on a portion of income. Again, that's a constitutional requirement one state can't tax all your income, and there's usually the way the let's say court sanctioned approaches to apportionment are very commonly used by all the states, which is basically either payroll, property, and sales factors. You know, what's the percentage of each one of those in the state compared to your total payroll, property, and sales? And more recently, and quite frankly, at this point, the majority are not even all three of those. Now, a lot of states are just using single sales factor. So even if the public law doesn't apply, right, that doesn't mean the state gets to tax all of your net income. They can only tax a portion net income. And so, no, you're not going to pay tax on all your income unless all of your receipts were generated there and all your properties there and all your payrolls there, in which case, you know, public law 86272 goes out the window. So.
Great, that's exactly, I think, the answer that we were looking for. All right, I think we're almost at the end of the hour, Rich. I want to thank you for your insight on how business is changing in the States. And I guess we have to stay tuned to the continued changes as our businesses change and grow with technology. Yeah.
Yeah, I'll add one more thing.
Sure.
I know at the hour, California adopted the FTC rules, but the California court overturned it, not because the rules are not valid, but because California didn't follow its own rules for how do you enact the regulation. So very shortly, California will also have the MTC rules. That's
just the delay in implementation then.
So the key here, right, Lisa, I think is, you know, as a business, be aware that this is out there. If you do a lot of web-based businesses, a lot of internet-based sales, you know, start thinking about, is it possible to plan around this? Are there states where you're currently not paying net income taxes because you have protection traditionally, where now if you keep doing business the same way, suddenly you're going to be paying net income taxes in that state where you weren't before? Can we plan around that? I think that's the reason I selected this particular subject is because it's happening now, and no time like the present.
Fantastic, thank you, and I want to thank all the participants who attended. You know, I'm sure everyone got a nugget of good information, and enjoy the rest of your afternoon. Thank you.
Thanks, everyone. Thanks, Lisa.
Thank you. Thanks, Rich. Appreciate it.